Thank you everyone for joining us for today's conversation. I'm D'Arcy McConvey, the Director of Capital Markets at Greybrook Realty Partners, and I'm here today in conversation with our CEO of Greybrook Securities, Sasha Cucuz. Welcome, Sasha. As you may or may not know, Greybrook's in the business of investing in residential development and in value-add opportunities across a number of markets, including the Greater Toronto Area, the Greater Golden Horseshoe, and other select major markets across North America. Our portfolio consists of north of 50 active projects, again, in both development and value add. And so, we feel like we have a pretty broad reach and partnerships, both with investors and developers and operators in a number of cities and places. So the purpose of today's recording is really to connect with our partners, including our investors, and offer firsthand experience as to how we're managing through the immediate impact of the COVID-19 pandemic, how the pandemic is ultimately affecting the portfolio, and how we're thinking about various facets of our business, both today and into tomorrow. So I know we've all read a lot about the impact, and we continue to follow the COVID progression. It's really an unprecedented time as the pandemic is being felt across all sectors of the global economy, and no industry is immune to the impacts of the pandemic. So we're not here today to attempt to predict the future, nor do we believe that we're always right in our assumptions, but we just want to offer sort of a little bit of clarity and give you an idea of sort of where we sit and how we're operating day to day. So Sasha, in the letter that we recently sent out to our investors, I guess it was last week, where we said it's still too early to comment on the potential long-term implications that the pandemic may have on our portfolio. Can you elaborate on that? Do you see that as still being the case?
Yeah, sure. So before I go there, I want to as well thank everybody for taking the time to listen. I think, when D'Arcy and I spoke with the rest of our team, we felt it was a really good idea to connect. And, we know there's a lot of questions, a lot of, things may be going through people's minds. And one thing as a management team, we really wanted to try and do is be as open and communicative as possible, because I think it's important, that people at least know what we're doing to the extent that something can be done. As you pointed out, there are things that are in our control. There are things that are not in our control. And right now, nobody has a crystal ball to predict the future. So as best we can, we want to try to give further context to our investors and other stakeholders where it's appropriate. So, to get to your question, we kind of pointed out that it's still kind of early in the game. If I had to kind of characterize it for you from my vantage point, I think Peter shares the same view that I do. Firstly, COVID itself, there's a lot of things that are unknown to us. We don't know how long the current state of the world, with the lockdowns that are in place, are going to last. Similarly, we don't know what things are going to look like coming out of this sort of acute period of this pandemic. When people return to work, is it, what does the new normal look like, and how long does it take to get back to a new normal? When you read about the pandemic from an economist perspective, and obviously we spend a lot of time synthesizing information, a lot of economists will tell you the same thing. There's people that are hoping for sort of this V-shaped recovery. There's people who think it might be longer than that. Nobody knows for sure, but the one thing we do know, and I think across the board people agree upon, is that the federal government in Canada and in most other developed countries around the world reacted very quickly in this context. A lot more quickly, for example, than in 2008 and 2009 with the fiscal crisis, the financial crisis that we endured. So I think everybody's on the same page in terms of trying to do whatever we can from a stimulus perspective to buy as much time as we can and keep that economy on ice, so to speak, so that when we come out of this 3 months later, 6 months later, whatever that time frame is, that we're not we kind of have a running start, that we're not starting from zero, but rather we've managed to keep things on a treadmill, on pause, so to speak. So without knowing how long things are going to go or what things look like after the fact, it's very difficult to assess what long-term impacts are going to look like. In the short term, there's obvious impacts, right? People on construction sites, for example, aren't necessarily able to work as efficiently. In most of the sites that we have under construction today, construction has continued, but not at 100% efficiency. Obviously, we've had to put in safety measures, we've had to put in social distancing measures and other protective steps to make sure that workers are safe. And as a result of that, you just can't be working at 100% efficiency. So on sites that we are currently under construction, we're seeing anywhere between 50% efficient right through to 80 or 90% efficient. And it sort of depends on what's being done within the project at the current time. The second sort of immediate disruptions are anything that involves the municipalities. So when it comes to planning matters, when it comes to permits and things of that nature, I think that most municipalities, because construction has been deemed an essential service, there are services and there is interaction with those municipalities, but again, it's not as efficient as you would hope in the normal course. And as a result of that, municipalities have sort of prioritized the things that they absolutely need to get done on an emergency basis and the things that can wait. And as a result of that, from a planning perspective and other things involving municipalities, different projects have different impacts in the immediate term based on what we can accomplish working with our counterparties at the city. The way that the reason we can't make any predictions today as to what long-term impacts might exist is really because assessing the immediate term is only part of the equation. Think of it like a baseball game. You could start a baseball game and in the first and second inning, you're tied at 0. In the third inning, D'Arcy's team goes up 5-0. Sasha's team's in trouble, but there's still 6 innings to go. So we have to look at development the same way. It's typically a longer term cycle, and there's things that happen today that may or may not have an impact depending on the duration of interruptions and other factors that may come into play. So that's why we have to take a very patient and disciplined look at how we're managing our projects. And really the protocol today as an asset management team is to deal with issues that arise first and foremost, and not make any hasty decisions, because I think we have to sort of almost pause in and of ourselves when it comes to certain things, because until we have all of the available information, until we can understand fully what potential implications exist, it's just not prudent to make those type of decisions. So that's kind of how we're approaching things today. And that's why it's not always possible for us to go out and say, hey, this is what I think is going to happen, and this is the impact it's going to have, because it's still very early.
Sure. Yeah, and I think, if you break that down further, like you said, project to project, it's very difficult to answer those questions at times for a given project. Sometimes it's easier than others, but so I guess you talked a little bit about the planning phase and how it sort of varies a little bit municipality to municipality, the construction phase of development, which is, again, you're call it 50 to 85% efficient. How about, in the third sort of bucket, the sales and marketing bucket, how are sales doing? Like, you read a little bit around sales are down sort of week over week, which is understandable. And then can people actually like physically occupy if they buy? Can they actually move in?
Yeah, so on the question of occupancy, the one thing that we have going for us in the real estate industry as it relates to development is you're producing something that's essential, right? Like, this isn't a good or service that's discretionary. People that have bought homes and have made plans and are expecting to move into those homes within these occupancy periods, that's about as essential as it's going to get, right? Shelter is pretty high on the hierarchy of needs. So the cities, the development community, we've all sort of banded together to make sure that these occupancies continue to happen. Obviously, we've had to get creative when it comes to the use of technology, doing things digitally as it comes to signatures and other transactional items. As well, I think there's been a general willingness on the part of the municipalities to ensure that any permitting that's required as it relates to closing homes where people are expecting to move into homes can be obtained. Again, efficiency being the operative word. It's not moving at lightning speed, and it's not, unfortunately, sorry, it's not, going to be the most efficient process, but there's certainly a willingness to be able to accomplish this. So from a closing perspective, those are still happening. We have a project, for example, in Markham, 2 of them in Markham, that just happen to be occupying at this point in time. And we've been closing the units that have been scheduled to close.
In terms of sales, obviously, throughout this period, our sales centers are closed because of social distancing measures and the precautions that we need to take. Real estate is a very interactive experience for most people. They like to walk through sales centers. They like to speak to an agent or a broker and face to face or within a sales center. And in this particular case, during this time,
you're going to see less sales. But I also think that the development community and the brokerage community has, again, tried to be as creative and as innovative as possible to introduce different ways for people to transact, because there still are people in the market that are looking to buy a home, that are looking to make an investment, and we need to be able to accommodate those people. So, for example, we have certain sites that are our own. For one in Fort Lauderdale, Florida, for example, that's a rental building, and we've converted fully to virtual tours. Right. So from beginning to end, we're able to take somebody through a well-produced virtual tour. They can interact live with an agent online, and they can move ahead with their decision to lease. And we've been able to lease units even in the middle of these lockdowns. So I don't want to shed an overly optimistic light in saying that we expect, sales to just continue uninterrupted, because that's definitely not the case. But I think that the industry is doing what it can to accommodate those folks that are in the market. And so far, we've been able to do a pretty reasonable job.
Yeah, it's interesting when you think about what could be the lasting impacts of sort of this, working remotely or work from home. And then obviously, it pushes you to implement, in the case of virtual tools, like certain technologies that could be mainstays going forward, right? So it's almost like innovation, in times of desperation, which is quite interesting. Like, I think there's going to be a number of that. And the other thing is, when we talk about planning, construction, sales, like development by nature, there's often a lot of stakeholders and people with a say or seat at the table. And sometimes it feels like they're putting up walls versus bridges, where it seems like today, everyone, to your point, is banding together to get things done and get things moving quicker than they may otherwise, which is, that too is hopefully a lasting sort of takeaway from this work from home or tough situation that we've all been put in. So hopefully that carries on post, when we get back to some semblance of normalcy in our day-to-day.
Yeah, I mean, that's a great point. I think, not to get overly philosophical, but this isn't the first pandemic that humankind has seen, and we're still here. So clearly people have a resiliency and can be innovative in times where they have to be innovative. So I don't think it's as simple as throwing your arms up in the air and saying, okay, well, I guess we're all beholden to whatever happens and let the chips fall where they may. I'm just going to go play in the backyard with my kids. I am playing in the backyard with my kids, every other chance I get, which is an advantage of being at home. But I do think that people adapt, and I do think that human beings, have a very unique ability to try to forge ahead when times get difficult. And you mentioned that partnership is something, when you look at Greybrook, our tagline is exceptional partners, exceptional returns. And the partnership concept has been something that we've, it's been a tenet of our business since the beginning. And we're seeing, I think, more and more of that partnership come to light with all stakeholders, as you mentioned. So from our development partners that are willing to get on the phone at any time of day, at any time of night, Saturday, Sunday, I guess that's one of the things about working from home is every day's a Monday. So whatever the time is, whenever it's convenient for people, we're getting things done. And you mentioned as it relates to municipalities and other stakeholders, I think everybody has a genuine sense of, we're all in this together and we're only going to come out of this together. So rather than trying to stand in your way, I'm going to try to help you figure it out. And I think that that's part of a silver lining that we are seeing in this particular situation. And, I only hope that we continue to see it going forward. Because I do think there will be fundamental changes with the way that business is done and the way that people interact. And I hope that those are positive fundamental changes, not in a negative sense. People can be more efficient using technology. People can be more innovative using technology. Those are just two areas, but I think that people will take some of the things we've learned that have allowed us to get to the next level when all this is said and done. And I think that we'll adopt them permanently in the way that we see the world and the way that we do business.
Which would be great, right? Ultimately. So, when I think about sort of where we invest and why, and really the two big sort of product types are development, high rise and low rise, and then value add. So how would you say this sort of pandemic and this state has affected development or value add any differently?
That's a great question. Residential real estate is chopped up into several little categories. High rise is different from low rise, and
Sure.
rental buildings are different from, building housing that's for sale. So there are going to be different implications at different times, as will the geographies, right? So as you obviously know, and a lot of our listeners today will know, we invest kind of throughout North America. On the development side, we invest in South Florida quite heavily, as well as here in the GTA and Greater Golden Horseshoe. We've talked a lot kind of about what impacts in the immediate term we've seen in development around some of these, delays and disruptions. By and large, they're similar across the markets. In our South Florida projects, the efficiency of construction is a bit higher than it is here in Ontario. I don't know if it's a more conservative approach to governance here in Ontario than maybe in Florida. But I think by and large, the challenges have been similar, and we've approached managing them in a similar fashion. So I wouldn't say there's many differences there. On the value add side of the portfolio, so for those listeners who aren't familiar with that strategy, it's a strategy where we're buying existing apartment buildings and investing in their improvement and hopefully increasing their value over time as a result. That is a bit of a different management strategy today because, as I'm sure people have read about, people who rent are also, just like homeowners who have had some relief in the form of mortgages that can be paid 6 or more months later, and different incentives that have been put in place for homeowners. Renters have not had the same type of incentives in place. So obviously, you have to think about the fact that there are some people who, in this period of disruption where they've been laid off or lost their jobs, they're going to have some trouble paying their rent. So our focus as a landlord or an owner in the geographies that we own apartment buildings in has really been to sort of freeze our strategy as it relates to trying to invest in the improvement, right? So freeze the construction and trying to kind of turn over these units and increase their value. And it's become more of a focus on maintaining our occupancy and helping to make sure that we supplement the cash flow that's coming into these assets by making sure that we're recovering our rents wherever it's possible. So obviously, there are going to be some challenges, and we try and work proactively with those folks to help them meet their challenges. Like, this isn't a period of time where you're going to, notwithstanding the fact that the governments have put in freezes and eviction, just as a human being, like, you're not going to be throwing people on the street when they just lost their job in the middle of a, you know, pandemic. So regardless of the fact that you're not able to evict people, the strategy has very much shifted to trying to keep people in their homes, and working with them wherever it's possible to try to come up with alternative solutions where they can pay their rent. It may not be possible for them to pay today, but you can work out some sort of scenario where they may be able to pay you again in the future. So we're trying to work as much as we can with those folks. So far, you know, again, it's early, but we're now into April, and you know, April 1st in the industry was kind of a big deal as it related to, you know, how many people are going to pay their rents. And we've seen actually a really high proportion of people pay their rent. So, you know, it wasn't the drop off that everybody expected. People have been making their good faith efforts to be able to pay their rents. And where they haven't been able to, there's often assistance that's available to them, whether that's at the federal government level or in our U.S. Properties. The Red Cross as well as the Salvation Army have provided incentive plans. So we're working with all of those organizations to try to keep people in their homes. So it's a much more proactive strategy than, let's say, on the development side, where in many cases you try to move the ball forward wherever you can, and then you're sort of beholden to disruptions that exist. Over here, it's much more of a proactive strategy and trying to keep your occupancies up and making sure that people stay in their homes.
Right. So I think, you know, obviously taking care of people is the most important thing. But, you know, if you look at value add really specifically, but development in a way too, but, you know, in these crazy volatile markets like we've seen, you know, especially looking at the public markets and even some of the REITs, like they've been absolutely throttled in terms of valuations. You know, I think one of the reasons that we like and have always liked residential real estate and sort of value add sort of rental is that it's a relatively stable asset class, right? Like even in down markets, you know, one of the people will cut discretionary spending before they'll cut, you know, rent payments and the roof over their head. So, you know, I think hopefully that proves out, right, from the investor perspective, and while it does, you know, hopefully everyone sort of is taken care of along the way. But I think ultimately that's why we're in this sort of asset class, is because it is a resilient asset class in good and bad markets historically, and we think that trend would continue.
Yeah, so that, you know, think of it this way, right? When you see a lot of volatility in the stock markets, there hasn't been, even today, that much of a change in the fundamental strength of a company, right? Obviously, there's companies that have been impacted more than others, right? The hotel industry, airlines, and things of that nature. But when you see a sell-off, broadly speaking, in the S&P 500 or the TSX or whatever those indexes are, and you see a massive drop in value, that's because these asset classes are typically the most liquid, accessible asset classes. So as people need cash, that's the first place that they go to, right? They go to their bank account because that's cash. And beyond that, they go to their liquid tradable securities. So you see sell-offs happen because people need the cash. And in the markets, many of the players are not just individuals like you and I. They're funds that have leverage. There's margin calls at play. There's all kinds of different things that are driving the liquidation of securities and the precipitous drop in value. So one thing that's a benefit about real estate, aside from what you mentioned, which is, you know, again, in the hierarchy of needs, a roof over your head is pretty fundamental. So we are in a asset class in the production of housing that is pretty important, and it's probably the last thing that people let go of when it comes to discretionary spending and where they spend their dollar. So that defensiveness is what makes it resilient. But beyond that, it's the illiquid nature of large scale real estate, right? So when you think about if I had, you know, to come up with money today, I can go to my bank account, I can sell a couple stocks and get that money in my bank account the next day. For me to sell a giant piece of land or an apartment building is going to take me 6 to 9 months.
Right.
So And the transaction costs associated with that are much, much higher than, 10 cents a share or whatever, a penny a share in most cases when it comes to trading. So what you see when you see this volatility is obviously people are looking at the prospects for the future and they're reacting to it. And if they're feeling negative about the future, they try to liquidate and convert to cash as much as possible. And that's where they go. So in our asset class, fortunately, in this case, unfortunately sometimes, but in this case, this is one of the reasons it's so resilient. It's not very easy to transact. And as a result of that, by the time someone gets around to transacting, we're in a completely different economic cycle in some cases.
Yeah.
So when you think about what economists are saying today, I don't think that there's anyone that is looking at this as a permanent problem, right? They're looking at this as a temporary problem because why? Number one, there was no precipitating economic factor. It's not like demand fell off the map or there was some economic driver. And secondly, there are potential solutions. So the minute there's a antiviral available or the minute that there's a vaccine available, I think people will feel a lot more comfortable and we can go back to some degree of normal. So I think that the issues that we're experiencing today economically are temporary issues. Now, whether temporary means 6 months or a year or 2 years, we don't have the answer to that, but we know that it's a temporary problem. So when it comes to real estate and real estate transactions, you're not in the same game as the stock market where you're marking everything to market on a daily basis. That's why you'll see values hold up, generally speaking. So the numbers haven't necessarily come out yet, let's say in the GTA when it comes to real estate prices, but I suspect you'll see a drop off in transaction volumes, right? Because there's not a lot of people that are out there buying today for the logistical reasons we talked about, as well as potentially their feeling around the future.
Sure.
And there's also not a lot of people that are selling. So with no transactions happening, you're not going to see much of a movement in value. Whereas on the equity side, you're seeing, we went through a week last week where I think we hit the lowest point we've seen since 1920 or 29. And then we hit the highest single day gain that we've seen since, 2000 and God knows when, right? I don't remember the exact statistics, but if you looked at a chart over the course of the week, you saw more peaks and valleys in the Himalayas. And that's just not something you're going to see in the real estate market, particularly as it relates to the private equity real estate market, which is where we play.
Sure. So, not to, I guess to parlay off that, we talked a little bit of value add and why we believe that sort of it's a good thesis and again, good and bad markets, hopefully more good than bad, obviously. But, what about on the development side? Like, how do you feel that investment thesis will hold up in sort of a more of a depressed market or environment market?
Gotcha. So before I go there, I wanted to make one last comment about equities. You mentioned REITs, right? So sometimes people equate real estate to REITs and they see the REITs bouncing up and down and they're thinking, well, so look, real estate isn't immune to these sort of volatile gyrations. But when it comes to a REIT, those are tradable securities. They're very liquid tradable securities. So when you do the analysis on these portfolios, there hasn't been a lot of change in the NAV, what they call the net asset value, right? So when you value their buildings that they own, there hasn't been much change in the value of those buildings, albeit the price of their securities has dropped precipitously because it's liquid and tradable. So just another, I wanted to make the distinction because REITs are real estate, but the underlying real estate hasn't been as impacted as the price of the units that are available on the market.
Right.
So to get back to the question you just asked me is how does the value add portfolio look in a less than ideal setting?
Well, more
I think
more development actually.
Oh, development. I understand. So, I think that our thesis is driven, whether it be in our South Florida development portfolio or in our Greater Golden Horseshoe GTA development portfolio. It's all based on a very fundamental thesis as I call it, a land scarcity. So what that means is there is a lot more demand for the housing that we are producing than there is the ability to get supply to market. So there's a disequilibrium, and that makes a very good fundamental environment for price growth. So if economic conditions change, there's a few things that we have to consider. So firstly, the depth of an economic change, right? Like, are we in a prolonged period of recession, and what does that do to employment? Those factors have to be considered. But if you look at the specific circumstances that exist today, in terms of what we all believe will be sort of a temporary phenomenon as it relates to our economic recovery, I see development performing quite well. You have to remember that when we buy a property, we do so with a posture that allows us to wait in most circumstances. So we may have an intention today when we buy something to launch sales in a year. So we could have bought something last year with the intention to start selling it today. Well, guess what? We're not going to start selling it today because it doesn't make a lot of sense.
Right.
But through our acquisition structure and the way that we bought the property, it enables us to kind of wait for a period of time where it does make sense to launch. So projects may go longer in certain circumstances, but we do believe that the demand supply equilibrium disequilibrium that I identified is going to continue in the long run once we get past this sort of period of pause, if you will, even if there is a more prolonged period of recovery thereafter. I'll say that, the biggest factor, I think, at least as the GTA and Greater Golden Horseshoe are concerned, one of the things we may see is a drop-off in immigration for a period of time. Whether that period of time is 3 months, 6 months, or a year, we don't know what that is. But I do believe, just like we saw back in 2010 and 11, after the 08-09 financial crisis, the buyers that didn't exist in Toronto's housing market in 08 or 09 because they were concerned or because of, the world was in financial turmoil. By 2010 and 11, we shattered records as it related to sales volume. What that told me was not that 2002 and 2010 and 2011 were so great. It just told me that if you had normalized the distribution over 08, 09, 10, and 11, it's about the number of dwellings that this city needs to be able to service the demand that exists. So I believe we'll see something similar as it relates to immigration, which is a big driver in the Greater Golden Horseshoe and Greater Toronto area for housing. If there is a pause, however long that pause is, I think that we'll see a surge in immigration thereafter, because I think, at the federal level, we've recognized that the way that our country needs to grow, the way that we need to continue to prosper from a gross domestic product perspective, is to bring in new immigration. So we target about 350,000 a year at a federal level. About a half of that or thereabouts settles in kind of southern Ontario. So if we see those numbers decrease, it'll be a temporary decrease. So I guess the long-winded answer to your question is that, we do believe that the fundamentals of our thesis will hold, because, we're at a point in time that is exactly that, just a point in time. And you have to be built to weather the storm. But we do believe in a city like Toronto, or in a region like Southern Ontario, or similarly in our South Florida areas and markets, that demand supply equilibrium will exist again. And there aren't any systemic changes to that based on this exogenous factor that has impacted us today.
Right. So it's kind of like, pick good markets, and over the longer term, we believe that they'll be stable, and sort of that trend line will tick up, right? So staying patient is ultimately a big theme, I would say.
You just said it. I mean, like, I think the one thing, I find myself repeating, and you've heard me say this, and I bet, the people at Greybrook are sick of hearing Peter and I say this, but if your investment strategy changes on a dime, it wasn't much of an investment strategy to begin with. If you think even outside of real estate, some of the most successful investors in the world the Berkshire Hathaways, the Warren Buffetts of the world, they've invested for the long term. They have a fundamental thesis. They make investments not for a day, a month, a year. They make investments over the long term, and the volatility that might exist in between will only even itself out over the long term.
Gotcha. Great answer. So I guess to kind of bring it to a close, a couple final questions. One is, how will we be communicating with our investors and stakeholders sort of going forward? Will there be any additional communication outside of just access? We're still readily accessible as a team. Do you foresee anything in addition to sort of business as usual?
Yeah, I mean, aside from accessibility, obviously you said it, we're all accessible at any time. We're going to try things like this.
Sure.
If people that listen to this thought they got value out of it and like hearing from me or you or Peter, or we'll switch it up so that people don't have to look at my mug all the time. But we'll try different ways to be creative and engage with people and try to answer their questions wherever we can, understanding that we don't always have the answers, unfortunately, but we'll do whatever we can to keep you informed. So I expect communication in whatever form to be as frequent as it would always be, to try to give people the insight and the context wherever we can.
Yeah, making it more personal, I think, kind of helps. And in a digital world is the best we can do ultimately. So on that note, I would say marketing suggested that I ask these questions to you and you do the same. What are you reading and listening to outside of work-related content?
That's a great question. So aside from, a couple hours a day filled with listening to Mariah Carey's greatest hits, because she is my favorite artist.
I can't believe you.
And now potentially thousands of people are going to know that. But yeah, so I like to kind of spend as much time as I can, trying to understand everybody's take on the market. So I listen to economists like Benjamin Tal. I listen to David Belsky at BMO. I try to tune into webinars. I'm an investor with KKR, for example, and they do some great webinars to try and kind of bring context. And I also try to understand as much as I can on the healthcare side of things, just to keep myself informed, because I think it's important for everyone, whether you're still going to work or whether you're at home with your family, to be as informed as you can around how to A, protect yourself and your family, and B, make sure that we're doing whatever we can and doing our part to be able to flatten the curve, as they say. So between webcasts that I listen to in the healthcare sphere and economically, that kind of fills my days, and the rest of the time I spend listening to my wife tell me the various things that I have to do now that I'm at home.
I hear you on that one. Awesome. Well, I think that it was great connecting with you. Hopefully the listeners found a lot of value. I think you offered a lot of insight on the development, the phases of development, sort of where our heads are at as a firm. And again, just emphasize the fact that we definitely don't have all the answers, but we're working hard to get them, and we're accessible, and look forward to hopefully doing this again soon. So thanks, Sasha. I appreciate it.
Great. Thank you. Thanks, everyone.